So to give an example, in Singapore, a low-cost import Japanese car brand costs around $140,000, while only requires a down payment of $42,000. However, even if you only need to pay up 30% down payment, please bear in mind that most car loans make use of simple interest, where the interest charge is calculated on the amount left over after paying your down payment. This means that your monthly car installment will be higher, especially when interest rates are high. Apart from that, there is also a thing called the rule of 78, which some banks use and costs even more than simple interest. If you end up repaying your loan earlier, this rule will come into play. This means more interest will be charged. This is why I do not take car loan, and I prefer to buy a car with cash rather than with a loan. Here's an example for you on how an early loan repayment can surprise anyone buying a car, as the penalty charges of the rule of 78 can be a shocking, expensive experience. The rule of 78 is a method used in finance to calculate the interest paid on the loan over its term. It front-loads interest payments, so more interest is paid early in the loan, making early repayments less beneficial. Here's a case study of a car loan installment, which is about $1,061 a month. Let's say that you decided to settle a loan amount of $50,000 because you receive a fat bonus payout from your job. You read your monthly statement and think you can pay the loan off with the $50,000 cash on hand. However, you'll be surprised to know that the finance companies or banks will ask you to pay typically 20% of the unpaid interest and 1% of the initial loan amount. Also, there's a thing called loan delinquency, where you are unable to make payments on time. Your loan will become delinquent, and then you will be at a disadvantage financial wise. Loan delinquency can not only affect a person in his application for credit cards, car or home loan, but can also jeopardize one's career due to it being a permanent record. If you are interested, for just $8 exclusive GST, you can buy your own credit report either from the Credit Bureau Singapore Private Limited or the BP Credit Bureau Private Limited to assess your personal credit worthiness. Actually, not getting a car and taking public transport or even Grabs from time to time will still work out to be cheaper than actually owning a car. At the end of the day, you should really think of the reasons why you want to get a car. Do you really need it? Can you afford it? Can you get a car and still have sufficient funds left over? Or are you just buying a car because you think it is a natural way of things? You can also factor in how close you live to work. If you do not have the means to take on heavy financial burdens such as that of getting a car, then don't get one. And if you do decide to get a car, then make sure to consult a financial planner, not a car salesman. A competent one will be able to advise you on the best car loans and the one you choose to take up. Car loan finalizations can only be something to skim through after all. You cannot just read through briefly, we need 1 minute and sign on the agreement without knowing what you are getting into and your liabilities. They can also advise you on proper car insurance coverage and perhaps even personal accident insurance. And then you know the different types of coverage. Car insurance premiums are typically not uniform as the age and experience of the car driver, and their past claim experiences also affect it. And if you are confused about the rule of 78, do ask your planner on what is it do. Basically, a financial planner will be able to help you with those long tasks and cover everything car related from A to Z. With that, I hope this video has helped you gain some clarity on whether not to get a car and how car loans can affect you financially and personally. Thanks for watching.